Good evening, everyone. My name is Joanne Lee, and I'm the head of Maybank Privilege and Emerging Affluent. Welcome to the Financial Empowerment Series brought to you by Maybank Privilege. Now, last week, we spoke about wealth creation and how young adults can get started with their wealth journey. We spoke about how we need to start now, inculcate a savings habit, monitor your expenses, plan early, and set your financial goals using tools on Maybank to You. We also spoke about how investments and insurance fit into the plan. If you would like to know more about the topic, you can find out more on our video online by searching for the Maybank Privilege Financial Empowerment Series. Today, we will talk about individuals currently between 30 to 45 years of age, many of whom are either married with kids or are about to plan to have a family. We also have individuals who may not be married yet, but are considering tying the knot and starting a new chapter in their lives. Of course, some would rather be independently single to provide for their families or to pursue their dreams and inspirations. This is also because some of them may have obligations and responsibilities that is required of them. Whichever choice the individual makes, there is a common denominator. These customers would have garnered a certain amount of savings and would need to have funds either for their children's education or for big-ticket purchases like a house. Now, in Asian cultures where family ties are very important, they will also need to care for the well-being of their parents and sometimes even their siblings, from the parents' health to their lifestyle needs. This means they will also need to have a certain level of emergency funds set aside, be it for their parents' medical or their family travels, or even for house maintenance. So if any of these scenarios sound familiar to you, you will find today's conversation of relevance as we talk about wealth accumulation and turbocharging your wealth to meet these needs. Now, before I introduce my guest today, I would like to also let all the viewers know that you stand a chance to win 500 ringgit if you stay on until the end of the show, and I'll tell you how you can actually do that. So, joining me again today, please welcome Mr. Tan Wei Yin, Head of Client Portfolio Modeling at Maybank Group Wealth Management, and Ms. Tay Yi Ling, Head of Channel Development at Etika Life Insurance Berhad. Welcome back, Wei Yin. Welcome back, Yi Ling.
Hi, Joanne. Thanks for having us again.
Thanks for joining us again today. Last week, when we ran the first episode, I think we garnered quite a lot of interest from our viewers. So thank you for sharing, and I'm really glad that you're here today to share more inputs with our audience. So it's going to be another info packed with information, so I shall get the session started. Now, Wei Yin, I would like to direct this question to you. So last week when we talked about wealth creation, so suppose our customers have actually garnered some of this wealth, right? They started, they have set goals, and now they have some savings, right? So does that mean they can now sit back, do nothing, relax, and just watch their money grow and compound?
Okay, I think when it comes to financial planning or even investment planning per se, we always encourage people to be committed for the long term, stay invested, right? As much as we advocate that, investing or even financial planning is not something that you can set it and forget it, right? So when it comes to reviewing your plans, reviewing your financial plans, there are mainly two areas to look out for. The first is on your objective, right? The next one is actually for markets.
Right.
So within objectives, it's quite straightforward. Simply put, you need to look at them in terms of whether those objectives have changed, right? Whether or not there's a change in terms of the circumstances or even your personal circumstances, whether or not the horizon has changed, whether you are putting the plan forward or even backward. So if you have changes to those objectives, right, chances are you may need to tweak your portfolio as well as your financial plan a little to accommodate those changes. On the other hand, on the other side of things will be the market conditions, right? You need to make sure that the portfolio that you have is aligned with what you think about the market. If you're optimistic, chances are you will have slightly more equities exposure. If you're more pessimistic, you will have more fixed income. So you need to make sure that your portfolio is reflective of your latest situation.
Right.
Then again, for investors, right, there's actually a lot of things that goes into portfolio review, right? You need to have time, you need to have the resources to know whether or not the information that you act on
Yeah,
it
that's true.
is correct, right? So it can be tedious, it can be confusing at times. So like many of us who, turn to our doctors to keep our health in check, we can actually turn to financial professionals to keep our financial health in check. So that
Right.
is how we usually recommend our investors to go about portfolio review.
I see. So basically, it doesn't just end there. So it
Right.
doesn't mean that once you have an investment, you can just sit back, right? You have to do regular review.
Yes,
So,
exactly.
Yiling, what about insurance? Do they, once the customer has purchased insurance, right? So does that mean that they can also just say, I'm done, I'm sufficiently covered, and I don't have to look at insurance policies anymore? Would that be a safe?
When it comes to insurance planning, generally what the most of us will do is after we got ourselves a plan, we will not look at it anymore.
Yeah.
And when someone approaches us for insurance review, insurance planning, we will tell them it's okay because we already got ourselves a
Very
plan,
true.
right? So I don't want to talk about it anymore. In fact, like what Wayne has mentioned, same goes to all the financial portfolios that we have, right? Insurance plan also needs an annual review. Yeah? So the reason why is that firstly, as we progress in life, our responsibilities increase. So from single to married, we then have
Yeah.
children, our parents then retired, and all these life events will impact the total coverage that we need. Secondly, we also increase our commitment along the way. So have you been taking up a new loan? Have
Yeah.
you been upgrading your car? You got a new house, have you been promising your kids their favorite universities? Is your wife a full-time housewife? So all of these will also require us to review our coverage on a regular basis. So in short, for us to know if we are having the right policies and also the right amount of coverage, we should speak to financial advisor at least once a year
Yeah.
or whenever there is a live event happening. So at Maybank, we are pleased that we actually have an app called EVIA, in Ethica Virtual Insurance Advisor. So through this app, our financial advisor will be able to help our client with their financial portfolio review by taking into consideration their asset, their liabilities, their current coverage, their income, their family members, or any life-changing events. When they take into consideration all of this, and then we will perform a portfolio review for the customers to find out if there is any gap and if there is anything we need to do about it.
Yeah.
Sounds very holistic.
Yes.
Yep.
And I also remember you mentioned that in the last episode about EVIA, right? And I
Yes.
think this is a good tool because all of us go through certain life stages, right? But we may not know exactly what it is that we need to do or what we need to have, right?
Exactly.
So maybe this question I will direct to Wei Yin,
Right.
right? Last week we spoke about Farah, right? So suppose Farah is now in her mid-30s,
Okay.
okay? And she listened to what you said, and she has generated savings amounting to at least 1 year of her annual salary. So she's got saving 1 year. And what she did was she put her savings entirely, like most customers, put it entirely in fixed deposits, right?
Okay.
So now the question is, as what you mentioned, she should review her portfolio. So Farah should review it. But what actually is she reviewing it for, and what can she do to enhance the value of her wealth, right? And how does she know if she's not missing out on a better yield or a good stuff out there?
Okay.
Yeah.
When it comes to this, I think we will look back at the initial scenario that you have laid out, 1 year worth of annual salary
Yes.
within savings. I think that is actually pretty commendable from an individual's perspective. You have that within your savings. But then again, it's very hard to generalize whether or not that is sufficient for you, for me, because each of us, we have different circumstances.
Yes, that's
right?
true.
And as we grow older, I remember you speaking at the start of the show, we will have more responsibilities, right? We will have more obligations. For those that are starting a family, you need to take good care of your kids or even your spouse that are not may not be working anymore. For those that are still single, you might need to extend your umbrella to cover for your parents. So chances are, as we grow older, your emergency fund requirements will be larger, right? So first step for Farah is to evaluate whether or not her emergency fund is sufficient to cover all of these aspects. As a rule of thumb, we recommend 6 months of your money expenses. Once you have sorted that out, right, the surplus, you can actually, we will actually recommend you to allocate into investments so that your extra assets will work harder for you.
Yeah, but
Right.
wouldn't the emergency funds that you spoke about of 6 months, is that not in investments?
Okay, when it comes to emergency funds, usually we wouldn't allocate them into investment vehicles per se because, as the name says, right, emergency funds is something that you want to tap into it when the
Yes.
circumstances arise and it's immediate requirement. It can be walking towards an ATM machine, insert an ATM card, and get the necessary cash to meet those obligations. So that is quite different compared to investments. When it comes to investments, once your fund goes into the portfolio, goes into the investment vehicle, chances are you will need the fund to stay there for some time, allowing it to grow because ultimately, when you are investing, you are putting money into businesses. Businesses don't grow overnight, per se. So when it comes to emergency funds, I think there are actually 3 avenues for you to consider where to put them. The first is pretty straightforward, current account or even savings account. Those are those will accommodate for most of the immediate emergency circumstances. It can be, a visit to the dentist, it can be a car breakdown, it can be some small home improvements that you require out of the sudden. For those extra funds, that you may not need immediately, you can actually consider money market funds. Okay, so money market funds, I think some of the audience may not be aware. Money market funds is actually an investment vehicle, unit trust fund that pulls together investors' fund and invests into institutional fixed deposits, right? So it allows you to accumulate interest on a daily basis, and usually the interest is higher than your current account and savings account. But there's a catch. You are not able to access the money immediately. Usually the withdrawal process will take at least T+1 business day.
I
So that's the
see.
catch.
I
But
see.
they compensate you with more interest, right? And for those funds that you're really sure that you won't touch it most of the time unless there's a big emergency, you can actually lock it away within FDs. So that will allow your emergency funds to also work very hard for
Yes.
you when you're not using them. So when it comes to investment, then we will go back to the topic where you asked about how much return is enough, right? We will actually need to map those back to your objective. Can the returns that you're earning now, help you meet your goals or not?
Yeah.
If it doesn't help you meet your goals, then chances are the return is not enough for you, right? But when it comes to managing investment portfolio, right, we try not to put a lot of focus within investment returns because to generate those incremental 1%, 2%, there's a lot of work that you need to put into it. You need to do research. You need to find out what are the investment vehicles that can give you those kind of returns. And you need to know the risk also. And chances are, before you step into the investment vehicle, you don't know much about what's the
Yep.
risk like, what's the up and down going to feel like, right? So we tend to avoid that.
Right.
But what we encourage investors to do, instead of focusing on investment returns, focus on elements that are more within their control. So there are 2 things here. First element will be savings rate.
Okay.
Increase your savings. Monitor your budget tightly, avoid leakages, right? Save every single dollar. And that will actually help you to reach your investment goal faster. And number 2, plan ahead. Don't wait until the very last minute only you decide, I want to come up with a fund to help me to fund a purchase next year, right? Plan ahead so that you have enough time
Right.
to build your wealth, right? And that will actually reduce your requirement of high investment return.
I see. So still quite a lot of available tools that
Yep.
someone like Farah could consider.
Yes.
So if she has already met certain goals, right, and given that she has actually gotten a whole year of savings, she can actually diversify it to some of the asset classes that you just spoke about.
Correct. So over here, we actually put in a slide, right, to
Right.
show you the benefits of starting early.
Oh, yes.
So there's 3 scenarios here. There's Farah, there's Putri, and Amina. So their end goal is at age 55, right? So Farah decided to start her journey early. 20 years earlier, right, she decides to commit 5,000 savings a year, right, within a portfolio that earns you 6% return per annum. And after 20 years, she's looking at close to 200,000 worth of savings, which is
Wow.
quite commendable, right?
Yes.
The second case for Putri, she starts 5 years later.
Right.
Right? She's a little slow, start 5 years later. She saves 50% more. compared to Farah, and invest within the same portfolio. And she landed quite close to 200,000, but still falls behind Farah.
Right.
Right. And we have the last scenario for Amina. She started 10 years later compared to Farah. She commits double amount of the savings, earn 15% more investment return within the portfolio, and yet she is still falling behind Putri.
Right.
So this chart actually illustrates the importance of starting early, and you don't have to focus too much in terms of the return. You don't need to commit too much in terms of savings. You will still have a better outcome compared to those that started later.
Yeah, and it goes back to what you also mentioned just now. Increase your savings rates and
Yeah.
also start early, right?
Yes.
So that's very interesting and very useful. And what we saw also, good for Farah that she started very early.
Yes.
Now, the next question I would like to ask Yiling, right? So we saw earlier in the chart that Farah, in 20 years' time had accumulated a certain sum of money. Now, suppose in a situation where our customer has started a family, right? And they have children. So they know that, let's say, in 15 years' time, right, their children will be of university going age, right? So maybe from an insurance perspective, what can the customers use it to help them plan better when the day comes, when the child goes to university?
Well, generally, I think we believe that parents would have started the education planning for their kids since the day the baby is born, right?
Right.
So, from an insurance perspective, we can actually look at education planning from from a few different angles. Firstly, is there are many beautiful insurance products out there. Comes with saving elements, comes with guaranteed and non-guaranteed returns, and some kind of life protection. Yeah. So those plans can actually provide a decent cash flow. They are relatively lower in risk as compared to investment, and they definitely can be treated as one of the financial tool when it comes to accumulating education fund. Secondly, well, we can actually look at using life insurance as a financial tool for education planning is more of an income protection angle. So take it for example, if we have a medical insurance plan for the parents, that will very much help to ensure that we do not need to liquidate our savings. We do not need to withdraw the education savings, right? When situations come where we need to pay for medical bills,
Yeah.
when we fall sick, when we are faced with accident.
Yep.
So I would also like to point out one thing, especially for the breadwinner of the family. So when everything is running smoothly, with our income, with our salary, which is supposed to increase on yearly basis, with our regular savings and also our investment, definitely we will be able to accumulate the education fund. However, have we ever wondered, how do we ensure that our children will still have this amount of money even without us around? Take it for example, if we pass away unexpectedly due to accident or even illnesses, where do they find the money for their education? So another important area that insurance can play a part is being a tool to ensure that without us, our children will be having this kind of money when they need to go into university. So insurance can actually come into picture from a different angle. It depends on how you look at it.
Yeah.
Yep.
I think that's very interesting that you shared, right? The different types of insurance plans can actually be used towards planning for your child's education.
Yep.
And I used to only think that in insurance, you just buy an insurance education plan and you're done for, right? So that's not necessarily the case. And what you mentioned is really helpful because you plan not only for your child's education, you also think about unforeseen circumstances
Exactly.
and to plan for income replacements.
Yep.
So I think that's a very good key takeaway for me. Now, from an investment perspective, Wayne, can we also look at investment tools, right, to help maybe generate the sort of funds needed for our child's education, whether it's for the fees or for their cost of living expenses?
Okay, for investments, I think as long as your financial goal involves a reasonable horizon, at least
Yeah.
3 to 5 years down the road, investment can be a decent vehicle for you to accumulate your wealth, right? Unless you need the money in the next few months, it's very hard for investments to materialize those objectives. But if let's say you have some time down the road, investment is certainly something that you should consider, because when it comes to investments, you are essentially investing in businesses, right? And businesses earnings tends to grow along the years, and it grows along with inflation. And in other words, you can have better potential returns as well, right? To help you to have those elements of inflation hedge. And aside from that, investment is very flexible because you're able to do asset allocation, meaning to say you can decide how much equities are you consuming, how much fixed income exposure do you want within your portfolio. And you can actually match those asset allocations to the horizon that you have.
Right.
If let's say today we start with a baby scenario, if you're planning for a baby, chances are the baby will have 15 to 20 years time
Right.
before they reach college or even university age, right? If you have a long horizon, chances are the portfolio will have more tolerance for risk.
Right.
And that means you can have more equities, right? But fast forwarding 15 years down the road, the baby is now a teenager, right? 5 years away from college age. At that point in time, it is very unlikely for you to be able to consume as much equities risk compared to 15 years ago, right?
Yeah.
Because you're already nearing your objective, your
That's true.
goalpost. And at that point in time, we will actually advise investors to shift to more safety assets like fixed income or even cash. And as you progress towards your goal, right, it is advisable also for you to start redeeming your investment in a stage-wise manner, part by part, right? And you might even want to consider converting some of those pool of funds into the currencies that you desire, because I understand that some of the parents may want to send their kids overseas.
Yes.
If you need Aussie dollar, you don't change right on, right before the day you admit your kid, right? You need to start planning accordingly, because
true.
sometimes currency movements can be quite wild.
Yeah.
So if you do it in a stage-wise manner, phase by phase, chances are you will have a better chance of preparing for any unforeseen circumstances.
Yeah. So just from what I hear, it's actually a combination of solutions that we can use, right?
Yes.
A bit of insurance and also investments, and it also depends on the time horizon.
Correct.
Although I believe a lot of parents would start planning early, so I really hope not. They don't leave it until just a year before they need to go to university. Usually, they can use that to kind of boost the amount, maybe for the cost of living. Now, for all our viewers, we actually have a demo to share later in the show on how you can prepare for your child's education. So please stay on, because this demo will actually help you in your planning, but it's also linked to how you can win that 500 ringgit that I was talking about earlier, right? So stay tuned until the end for that announcement. Now, coming back to Wei Yin, right? I know we spoke about this in the last episode, but remind us again, is there such thing as the best asset class? And how do we know which one's for us?
Okay, unfortunately, there's no one best asset class for everyone. It's always a balance of this and that. Just like your diet, there's no best food, right? You need a combination of nutrients, you need your carbs, you need your proteins. It
Am
works
I ice
similarly. Yeah, dessert. It works similarly within investment portfolios. So let us just focus on two main asset classes.
Okay.
There are still others, right? Within equities, usually they are able to offer you higher potential returns,
Right.
but they entail higher risk. Right?
Okay.
There's daily swings that you need to go through daily. Within fixed income, it's a lot more resilient, more predictable kind of investment vehicle, but on the flip side is the returns are not very fantastic. So if you ask me, what's the best asset class? Unfortunately, no. But there may be a best portfolio that is suitable for you.
Right.
It is tailored to your investment objectives, tailored to your risk appetite, and
Right.
it helps you to achieve your financial goal. On one hand, if you are being too aggressive, right, consuming more risk than you can take, the chances are you may not be able to sleep well at night when market situations are not as good. But on the flip side, if you are being too conservative, right, you are not putting your assets to sweat hard enough, to work hard enough for you to achieve those financial goals. So you need to strike a balance. There's no straightforward answer to how you want to allocate your money.
Yeah, and it all boils down to the individual again, right? And actually, how much you need and which asset class you go for really depends on themselves, their goals, and also their risk appetite.
Yes.
Right? So now coming back to Yiling, and this is also one of the questions that we get asked by some customers, or maybe they don't ask it, but there's always this expectation. So you shared with us why people would need insurance. Now, I'm sure some of us, or at least most of us, right, would have thought about this, that insurance is also an avenue to make money, right? And people tend to look at insurance and wonder how much value have we accumulated and how much money have I made from this insurance policy? So, what are your views on that?
Well, before we even go into answering this question, right, probably we want to ask ourselves, why did we buy that insurance plan? So the fundamental of insurance plans is always to provide different form of protection. May it be medical, may it be life, accidental, and whatnot. Hence, instead of asking ourselves if my insurance plan will help me to make more money, we probably can look at it from another perspective, how my insurance plan will help me to save money. Yeah. So why do I say so? Firstly, if we own a medical plan, so without further explanation, I think everybody understands that it is obviously helping us to save a lot of money when it comes to settling hospital bill. Right? So we will not be cracking our head looking for cash, withdrawing from investment, from deposit, when we need to pay the hospital. So secondly, if we have a good saving plan, which will covers our life at the same time pay us probably some regular cash flow. Yeah, so it will be a good retirement plan. It will be a good education plan because it pays our family when we are no longer around. And if I'm healthy and safe along the way, we probably can generate some cash flow from that kind of plan. So thirdly, if we have a legacy plan, so it is even more obvious that the plan is going to pay our loved ones, our next generation, or even our next generations, a big sum of cash when we are gone. So in short, what we can see here is that insurance gives us a lot of guaranteed benefits to ensure that not only we ourselves, our family members and our future generations, they are all well taken care of financially. Hence, it is really not so much about making money, but it is to ensure that we are covered in situations that when we need money urgently. Yeah.
Right. I think that's a good point, and I hope some of our viewers will have been wondering whether we should look at our insurance policy to make money.
Yep.
That's not what it's for. Now,
True.
if I turn it around and let's say I have a policy already, right, and I bought the policy for a particular reason, right? Now, if the policy hasn't matured, or there is no trigger of any claim, no event that triggered a claim, should we look at cashing out on our insurance? Or should we look at insurance policy and say, hey, let's make some partial withdrawals? Would that be advisable? And what would be the implications if
Well,
we did that? Yeah.
when we are buying into life insurance plans, as I keep mentioning, we definitely look for long-term protection, right? So it is generally not advisable to just surrender the plan because we think that nothing will happen to us because we will never know, right?
Yeah.
So another reason for not to surrender the plan is that later on we want to buy another plan, so we might need to pay a higher premium due to our age and whether or not our health condition still allows us to buy a plan or not.
That's
right?
true.
That is about surrendering. Whereas for partial withdrawal, I think of course we can withdraw when we have accumulated a certain amount of cash value in our investment linked plan. It is like a small little rewards, for ourselves because of our disciplined savings behavior. But the most important thing before we even withdraw is that the partial withdrawal should not impact the protection of our plan. Yeah? So the partial withdrawal should be just a small little, a small gift that we want to reward ourselves with, and our insurance plan must still be able to sustain.
Right.
So on the other hand, many of us, we keep thinking about withdrawing from the plan, but we can also considering topping up into the plan
Okay.
when we have some extra cash.
Right.
Yeah, so instead of withdrawing, which will reduce the cash value, when we top up into our investment link plan, we can treat it as another form of diversification. Yeah, so that will help us to boost our cash value a little bit as well.
I see. So ultimately, insurance plans are long-term commitments,
Exactly.
right? And you should not be looking at it as a means of making money or
Yep.
cashing out before its maturity. So what you really want to do is to sustain it, right? If I what I
Sustain it,
understand.
and when unfortunate events happen, we know that we are protected.
Yeah. Yes. I think that's very clear. Now, if insurance plans are not the place that we should look at to get, let's say, cash, right? That shouldn't be the place where we look for. What if, right, in a situation, um, what if in a situation the customer requires money, right? So as we mentioned earlier, some of our customers will have to take care of a larger family, right? Not only of their child or their spouse, they have to take care of their parents and sometimes maybe their siblings. Now, you never know when the house that they're living in requires some renovation, or if they need some medical attention and they need money, right? So maybe weigh in, right? What happens, right, if someone finds themselves in that situation? They need a certain sum of money. They shouldn't cash out on their insurance policy because it hasn't triggered any claim yet. So, what do you view? What are your views? Should we actually sell off our investments so that we can get the money that we need for whatever purpose? Maybe for renovation of the house or something like that.
Okay, if we are sticking strictly to your scenario, really no choice, no other option,
None.
okay, you will have to review the portfolio,
Okay.
and probably you need to consult your financial advisor on which part to liquidate first,
Right.
right? Depending on the performance, depending on the asset class, and you probably will actually redeem just enough to accommodate for those situation, right? But unfortunately, regardless how well we plan, there's still this probability where we meet those kind of situations. So to really help you to plan better, it's to I think keep your eyes out, keep your ears out, right? Because as we grow older, I think there will be more and more stories, more and more encounters around people around us, what kind of situations that they have been in, what are the
Yes.
kind of commitments that they need to come up with within a short period of time. Those kind of experience around you or even within the news can actually help you to envision or even plan better for those kind of things. So which is why relating back to the answer we discussed earlier, the questions we discussed earlier, as you grow older, chances are your emergency fund will have to grow alongside with you, so as to avoid this kind of situation. Because the reason why this is not really a good thing when it comes to investment, because within investments, the ability to stick around for a very long time without being forced to give up, without being forced to wipe out, is what makes the biggest difference. Because whenever you decide to liquidate your investments, it may not be the best time. Markets could be on a downturn. It won't be the best time. So if you are able to stretch your investment horizon for your investment portfolio, chances are your portfolio will be able to provide you the best outcome. And over here, we have actually illustrated within short term, let's say 1 month, 3 months, your chances of making money is probably 60% over the past 30 years.
Okay.
Right? This is a back-tested data with global equities. If you stretch the horizon long enough, as you can see, the probability of making money, the probability of positive returns actually goes higher.
Right.
And if your horizon is 10 years down the road, on average, right, if history is any guide, you will have 98% chance of making money. That is
Right.
the power of stretching an investment horizon, and that is the power of allowing money to work for you, allowing the power of compounding to work for your investment portfolio. So to avoid liquidating your investment portfolios or even looking towards your insurance plans for emergency needs, be sure to evaluate whether or not your emergency fund is sufficient, right? Have enough coverage for
Right.
those circumstances that you could not immediately prepare for instance, medical emergencies, for instance, accidents.
Yeah, that's true. Yeah, so I think that's very, very clear. And what I also picked up from what you shared is that your emergency funds should be something that is accessible also,
Yes,
right, and
yes.
liquid. And you do have all these different tools, investments, right, that you have different tenure, and you should stay invested as long as you can.
Yes.
But if you really need some money, you would have planned ahead for that sort of emergency funds, lah,
Correct.
right?
Yes.
So not to say that everybody should be paranoid at this juncture, right? It's all about planning early and setting aside the emergency funds, making sure it's accessible and liquid, right? Without surrendering insurance policy before it's actually matured. Now, I turn the scenario around. Now I have extra liquidity, right? So, what if customers find themselves in a very positive situation where they have some money, right? So can that be invested? So take for example, recently we had the loan moratoriums. So some of our customers would have gotten the money into their accounts. Now, should that be invested? And what if they need that later? They still have to pay their loans later. So your
Yeah, I
views?
think speaking of the moratorium, it relates to the pandemic, right? I think aside from the moratorium, there are also additional liquidities coming from ICNA, the
Yes.
withdrawal plan from EPF.
EPF.
So I think taking a step back, right, going back 1 year ago, if there's one thing that we can learn about the pandemic, it's how unpredictable things can be and how fast things can change. I think back in last year, a lot of us are expecting, okay, vaccines are going to roll out pretty soon. We are going to get over this pandemic in a very short manner, but here we are today, we are still facing daily cases of 20 over 1,000, right? So when it comes to excess liquidity, right, we will go back to the exercise that we advocate.
Yep.
Review your emergency funds first, right? Go to the financial planning pyramid. First layer, right? Focus on your wealth creation. Do you have enough emergency funds? Do you have enough savings, right? If you don't have, it's a good time to use those excess liquidity to buffer up your emergency funds, to buffer up your savings. That is what you should do. After you have sorted those necessities, then only you consider to move those assets into investments or even other avenues that can make them work harder for you. So it's the same process. Evaluate your emergency funds. If you have covered all of those, if you have taken care of your risk management, then only you move towards emergency investments.
I see. I think that's very good advice. Now, another question to Yiling, right? So Wayne has already spoken about what to do with money, the investment pyramid. So in the case of, let's say, a family man, right? Suppose, let's call him Jack, right? Jack is in his early 40s. He's got a family. So Jack actually already has existing policies, but because he has a family now, so does he need to consider taking more plans, like more medical coverage and all for him, for his spouse and his children? And will they also be covered in the event of COVID-related medical expense?
Well, when it comes to medical, right, in Malaysia, the medical inflation rate is rather high. It ranges between 10 to 15% every
Yes.
year. So last year itself, it was actually as high as 14%. So let us ask Jet, yeah. So if the medical cost in Malaysia is increasing every year at the range of 10-20%, so is your medical plan limit increasing every year as well? Right? So this is to ensure that the covered amount that we have is enough to catch up with the medical inflation, right? So same goes to critical illness plan. So the advancements of technology, the improved lifestyle that people are living, so that will also be an indicator for us to top up our coverage regularly. So for COVID-19 related, in Maybank and Etika, we actually provide the medical coverage for our customers who are diagnosed and hospitalized due to COVID. Not only that, because for those of our customers who face very serious side effect due to the COVID-19 vaccination and they need to be hospitalized, we will cover their medical bill as well.
Yeah, that is a very, very noble thing. I do see questions coming in from our viewers, so maybe we will start taking some of the questions.
Okay.
The first question is actually, I think I'll direct this to you, Elaine. It says, if I want to start an education plan for my 2-year-old. How should I start?
All right. Like what I have mentioned just now, we can actually look at this education planning from two different perspectives. One is we can actually go into some endowment plans, savings plans, which will actually pay us either guaranteed or non-guaranteed return. So that will help us to accumulate some education funds over times. One thing to stress is that this should be one of the financial tools for us to accumulate education funds for our children. It should not be the only one, the only
Yes, as you
plan
mentioned
that
earlier,
we go into. So the second perspective is, like I mentioned also, probably we can look at, if I am the breadwinner of the family, I might need to do some income protection planning or income replacement planning, so that I can actually be very confident to say that with me, without me, my boy, you can go to your favorite university. So probably we can start thinking around how we want to go about from these two different angles. And in terms of how should I start this, we will still encourage our viewers to talk to professional advisors to analyze our current situation, to find out the gap, and then take on some recommended solutions.
Right. And actually, this one is quite similar, but it says, how do I plan for overseas education? Malaysian ringgit is on downtrend. Maybe this one I will direct to Wei Yin, right?
Okay. I think I'll probably add on to what Yiling has shared earlier with regards to how do you plan for education from a goal setting perspective. Aside from looking at tuition fees, right, I think it is reasonable for you to take into consideration of the accommodation costs, living expenses, right, especially those that are planning for overseas. These are actually quite sensitive when it comes to inflation, when it comes to currency fluctuation. You will have to do more research in terms of, if let's say you are planning to send your kids to Australia, you probably want to talk to some kids that recently graduated, or to say teenagers that recently graduated from Australia, get their experience in terms of how is it like to live there, what are the things, what are the costs associated, whether or not the accommodation is always increasing in cost. That will give you a better idea on how to plan 10, 20 years ahead. And when it comes to the ringgit part, right, unfortunately, ringgit recently, due to the local political uncertainty as well as the economic headwinds that we are experiencing due to COVID, the ringgit is actually on a weaker side, right? So how do we plan for this is that we need to avoid having our portfolios concentrated within local assets.
Right.
So in the official term, we call it home bias.
Right.
And this is not something that is particularly within Malaysians only. For every country around the world, investors tend to have home bias, meaning to say that they have most of their investments invested in their own country,
Right.
because they are more familiar with it, they have more confidence in it due to
Yes.
that. But within a holistic, well-constructed investment portfolio, you should have overseas exposure. And when you have that, it helps you to diversify your currency risk, so you need not worry too much about ringgit going weaker or going stronger.
Right.
So in other words, if let's say you're invested in foreign funds or even foreign stocks, you are actually diversifying away your ringgit exposure already, because in order to buy those investments, you need to convert your ringgit into US dollar, euro dollar, or even the pound. So that is one way for you to plan ahead, and that is one way also for you to avoid clinging onto a single currency portfolio.
Right. And I think there's another question also, but this one is not on education. It's more on increasing insurance coverage. If I want to increase my insurance coverage, should I buy a new one or should I upgrade my existing plan? Yiling, I think that one's for you.
Well, it depends on whether you want to upgrade your existing plan, as if my existing medical plan. Probably I want to upgrade my annual limit, my lifetime limit. So by upgrading my existing plan, it will be able to allow us to actually cope with whatever that is the hospital is charging currently. So for buying a new one, it could be the needs could be arising because I have a new life stage events happening. Yeah. For example, if I have a newborn baby, probably I want to buy a new plan.
Yeah.
Just to prepare him for his education. So whether or not to increase coverage, should I buy a new one or should I upgrade? It depends on, is the existing plan still good enough? We do not know, yeah? Or if my new life event will trigger my new needs. Yeah? So there are a different consideration before we decide we want to buy a new one or we want to upgrade. So again, our advice is always to speak to professional advisors, to do an evaluation before we make any decision.
Yeah.
Yep.
Good point. And this one, the next question is sounds like it's quite concerning too. I'll direct that to you, Wei Yin. It asks, what happens if I'm near retirement and a situation like COVID happens? How do I protect my accumulated wealth?
Yeah, I think this is a pretty relatable situation because we are in the
Exactly in that
current
situation now.
Yeah.
Yeah.
So I think if I were to reword the question, it's how do I avoid a catastrophic market event from jeopardizing my financial goals that probably I only left with 1-2 years, or even I'm already at the goalpost. So it goes back to reviewing your portfolio. So earlier on we discussed there's two aspects of things, right? First is
Yeah.
on your objective. Second, it would be on your market views. So this has got a lot to do with objective. So whenever you have an investment fund dedicated to a particular goal, right, you got to review it periodically so that you know, okay, I'm now 5 years away from that particular goal. A year later, you need to remind yourself, I'm now 4 years away, 3 years away, 2 years
Kind of
away.
like a countdown.
Correct. And your portfolio has to accommodate
Right.
those kind of situation and changes. So for those investment portfolios that have shorter investment horizon, our recommendation is you should have more and more safe assets like fixed income, right? More predictable in nature, although lesser returns. Or even if you want to play even more safer, you might even start migrating some of those risky exposures, redeeming them at a profit and park them into cash, park them into the fixed deposit, where you are sure that when you need the money, it is already
It's
there.
there.
Correct.
I
So back to the same usual exercise, review your circumstances and make sure your portfolio is reflective of what you want it to be.
Right. And I think this one is also another question that I may direct to you. It says Malaysia's economy and market situation is very gloomy now. What can I do?
Okay.
Quite a broad question, actually.
Correct. There's actually a lot of things that you can do when it comes to financial planning, right? But I think based on a rough guess, I think this is an investment question.
Yeah.
So where should I invest? Where
Yes.
should I look to when it comes to this kind of situation? Fortunately for local investors today, you need not force yourself to invest in local economy, right? Within unit trust, investment vehicles like unit trust, you have access to global funds. You have access to thematic funds, right? So you can invest in the US stock market, you can invest in the Chinese stock market, you can even invest in the Singapore stock market through unit trust, because unit trust is actually a very diversified investment vehicle. You have access to different markets at a very affordable cost. So if Malaysia's situation is gloomy, you don't really like it, invest overseas. That is one very feasible way for you to do, and you should do that because, like we mentioned earlier, avoid home country bias. Right, you should have your money work hard around the world for you rather than just working in Malaysia.
Yeah.
Yep.
Probably is a good timing to diversify a little
Yes.
bit as well, right? So instead of putting everything into a certain type of investment, so if we do not have a very positive views towards the economy, of course, my advice will be to have a little bit more into insurance to ensure that if the economy is not going to be good, and in case situations happens, we have the insurance to be to rely on when it comes
Yeah.
to financial needs.
Yeah, that's a good point. That's a good point. Now, actually, the next question, I think you would have addressed that in your when we spoke about if you have a portfolio and you need something for emergency, which fund should I liquidate first? So I think we spoke a little bit about that,
Yep.
unless you have more to add to that question.
Probably I'll just add a little bit more. Caveat, this should be a very situation specific, case by case basis.
Right.
But usually we will look at the overall investment portfolios. Let's say you have 10 holdings, right? Review each and every one of them. I believe not all of them will move in the same direction. Chances are one will outperform the other. Some may move faster, some may move slower. If you are choosing to liquidate, try to liquidate those that are very similar to cash first. Usually you will have some cash exposure. So liquidate those cash first because they are not particularly affected by the market, right? Next, what you can look at is after you have liquidated those and it's still not enough, you look at those positions that are giving you the highest profit because chances are the money has worked hard enough, right? Then the last option that you should look at is actually those positions that are making losses. Yeah. But then again, this is a very general rule. Please consult your financial advisor to decide which holding you should go for.
Yeah. And I have this question, and I think I'll probably invite both of you to answer this question.
Okay.
So it says, if I'm no longer around tomorrow, should I instruct through my will to liquidate all my portfolio and distribute my wealth? How can I plan for this?
Okay. But maybe I'll go first.
Okay.
Right? It's a very important thing here because this audience actually has a will. It's very good because a lot of people are not aware that if today, let's say I pass on, if I don't have a will, chances are my next of kin or even my parents will take a very long time to assess my estate. Like in other words, my cash, my investments, if I don't have a will today and I pass on, it will take probably 1 to 2 years for my parents to reach whatever I have. Because the moment a person passes away, their assets and everything will be frozen.
Yes.
So this is a very important thing that I would like to take the opportunity to highlight. If you don't have a will, better to have one because a lot of people, especially the 30 to 40s, right, when you talk about will, they might say, I don't have much to will about. I don't have much on my hand. But if you're having a young family, if you have reliance, dependence, will is actually very important. And back to the question, right, should you liquidate everything? It is very situational, depending on who are your beneficiaries and whether or not the beneficiaries can handle that sum of money. If it's your kid, if it's your wife, right, you might have a different plan for both of them, and you want to actually plan ahead based on what they want. So I wouldn't advise you to just stick with liquidate everything and pass the money to them. Evaluate their circumstances, right? If the money is meant for your kid, you can have a will as well as a trust, right? To allow the money to grow until a certain age and probably have a drawdown plan. You can actually instruct the will or even the trust. They are very flexible to insert whatever customization that you want. It can be a monthly distribution, it can be a yearly distribution to your kid. It is very flexible. So you can tailor it to your own personal circumstances and don't just stick to one option. It's very flexible. So where should you seek advice is actually from a personal financial advisor. They will probably advise you on how you should draw down your plan, whether or not it's a good time to hand over this sum of money to your children. What is the common practice of other families? What do they do? So probably we can go around that line.
Yeah. So when we are talking about having a will, how do I distribute the assets that I have, right? So at this point of time, we realize that if we have a life insurance plan, that will indeed help a lot. Yeah. So while waiting for all the procedures that Wayne has mentioned, to take place. So when we have a life insurance policy, we all know that the death claims can come pretty fast. So if everything is in order, the beneficiary should be able to receive money, say, within 14 days. So if we have left behind a sum assured of, say, a couple of 100,000 or even 1 million, so that will be paid to the beneficiary in terms of cash. So, situation, especially when the death is due to some sudden costs such as accident, we do not even have time to plan for it yet. So this piece of money will come in very handy for the family to handle, the messy
Funerals.
situations, where do I look for cash? Do I still need to go to the bank and liquidate some of the things?
Yeah.
So that part, life insurance will be very, very useful when it comes to the immediate financial needs that the family has.
I think
Yes.
that was a very important question. I think in the interest of time, maybe we take one more question from the audience. So the question is, should I put my extra income, how should I put my extra income into good use? Should I use to settle my housing loan or should I use it to invest? Any views from Wei Yin or Yiling?
Yeah, I think this is quite in terms of preference also, because some people they deal well with debt. Some people prefer to settle off their debt. So this is again in terms of how you want to put it is actually on personal preferences. But then again, everything you can actually try to assign a number to it. So you can actually try to do a cash flow projection, right? If you settle your housing loan today, or even whatever outstanding debt today, what is the amount that you are going to settle it, right? You can use that equivalent amount and put it into maybe an FD account. So you can do a different kind of comparison scenario to see if I settle the housing loan today, 5 years later, what am I going to end up with?
Right.
You should end up with additional savings because you don't have that much money commitment anymore, right? But if you don't do that, if you decide to invest instead, what is the kind of returns that you can get 5 years down the road? So you will have two outcomes, and you decide which outcome that you are more comfortable with and more confidence with, then you should just proceed ahead. So these kind of comparison scenarios may be quite difficult to do on an individual basis. So you can actually ask your financial advisors or professionals to help you do those modeling or even projections.
Right. Any perspective from Yiling to that
Well,
question earlier?
say if we have extra money from an insurance perspective, of course, it's time for us to then review the coverage that we have, whether or not it is still enough to cope with all the necessary financial needs that might arise. Yeah. So if not, then probably we can top up a little bit into our coverage. We can probably buy into another plan. So it depends on like what Wei Yin has mentioned. Each individual at that point of time, what is the ultimate important things for him to go into at that point of time.
Right.
Yep.
So let's take one more question from our audience. This is quite interesting. Between investment linked plan and traditional protection plan with participation, which one would you recommend for young family with children's planning for long-term placement?
Well, I think probably we can actually look at how much do we actually plan to put aside.
Right.
Yeah? And also what kind of flexibility we want to have in between. So the difference between an investment linked plan and a traditional term plan is that investment linked, because it consists of investment element, so I get to choose which investment linked fund I want to go into according to my risk appetite. Yeah, and also along the way, because the audience mentioned is for long term, so we are talking about say 10, 20 years kind of thing. So in between, an investment linked plan will have the flexibility for me to perform a little bit of partial withdrawal. If we have 1-2 months of financial difficulties, we can opt for probably premium holidays, that kind of thing. Whereas if we want to choose a traditional term plan, it doesn't really have much flexibility. It doesn't have any cash value for us to withdraw, and the commitment is that I really have to be very committed into paying the monthly premium if I'm opting for a term plan, right? So first thing first is how much flexibility we want to have. Second is do we foresee that in between we might need to cash out a little bit from that kind of plan? So that will then for us to decide whether I want to go into investment link or I want to just go for a pure term plan. Yeah.
Okay. Well, I do see questions coming in. Unfortunately, we are a little hard pressed on time. And I do have something else to share with our audience in the time that we have left. So it's also related to your 500 ringgit prize, which I will announce after the demo. But for our audience who still have questions, you can drop your contact details with us or email us at gwm.marketing@maybank.com, and we will respond accordingly, right? So this marks the end of our discussion on how to turbocharge your wealth and continue your wealth accumulation journey. Now, remember, as shared by Wei Yin and Yiling, financial planning doesn't stop with executing your first plan. It requires regular review, right? And preferably early, on a yearly basis as your lifestyle changes and needs changes every year, right?
Yes.
So for young families, other than the current funds that you have that you need to raise the child, you will also need to plan ahead for their future education. So even when they are a toddler today, and you want only the best education and future for your child. So for those with family obligations, remember to also set aside emergency funds in case an event calls for it. So your savings and investment portfolio should be well diversified with solutions that are able to meet your short, medium, and long-term needs. So insurance is an important tool which also requires regular review to ensure they are sufficient to cover changing needs and also your enlarged family members.
Yeah.
Right? And remember, when it comes to insurance plan, it should not be viewed as a tool for making money, and you should also not have too high an expectation that it will give you very high returns, right? Instead, it should be viewed as a solution to manage your personal risks. I know today's session, quite a lot of concepts and quite a lot of info given to you, but here's how we have made it easy again for you to get started. Now, if you need to set up an emergency fund or if you have a certain wealth goal, you may refer to our first episode of our financial empowerment series. The video is actually uploaded if you need to check that out. Today, what we want to showcase is a short demo especially curated for parents out there. This is on the digital wealth tool on Maybank to You that can help you on your financial planning journey, focusing specifically on setting up an education fund. So please stay on right to the end, and I will announce how you can actually win 500 ringgit prize. Let's take a look at our Maybank to You financial goal simulator.
Generation after generation, the fees for higher education inflates along with the economy. To give your child the education that they deserve, you may want to consider investing. This way, the money that you've saved up can grow with time instead of decreasing in value over the years. Plan it all out with our financial goal simulator. It's a tool that calculates how much you need to set aside in order to make your money work for you towards achieving your financial goals. Click on the link below to learn more or just log in to Maybank to You and try it out now. In the Financial Goal Simulator, you'll be presented with 3 goal options. Select Education Fund for myself or my children to get started. Here, you are required to define your goal. First, click on My Child and key in your child's name and current age. Then, select the ideal level of education that you want your child to have, whether it's college, university, or postgraduate. After that, choose between general studies or medicine. There are only 2 choices here as the fees for medicine differs significantly from that of the rest. Next, choose from the available countries of education. Once that's done, the goal target amount will appear. This is the simulator's suggestion as to how much you may need for your child's education. Feel free to change the amount if you already have a number in mind. In the last field, key in the initial deposit amount that you can put in to kickstart your investment. If you're unsure, you can just leave it blank for now. You can also hover your cursor over the question marks to get a better idea of the information that's needed. Once you're done and satisfied, click on Show Simulation. You can always edit the figures again later. Right away, you'll see a customized financial plan for your child's education goal. On the left, the simulator suggests that in order to achieve 140,000 ringgit in 12 years, you'll need to invest at least 789 ringgit every month for the next 12 years. On the right, the graph shows a timeline starting from your child's current age to when the education fee is needed. We all know that investing, unlike holding cash or fixed deposits, involves risks and variation of returns. Hence, the three colored lines represent three scenarios in investing. Green is great, yellow is average, and red is low. The simulation that you're seeing is the average market performance based on our past data. From the graph, we can see that in the best economic outcome, you have a 25% chance of overachieving your initial goal with at least 188,000 ringgit. But if the market doesn't go as planned, you'll still have 75% chance to have at least 106,000 ringgit. While this is more of a general gauge, you can further customize your goal by clicking on Make and Edit. Here, there are two main fields that you can edit: your risk profile and your monthly investment. Let's start with your risk profile. Your risk profile is your willingness and ability to take risks with your money. Are you more willing to make bold moves for higher returns, or do you prefer to avoid investment decline at the price of foregoing potential capital appreciation? Here at Maybank, we know that everyone is unique, and so we've created 5 levels of risk profiles for your selection: conservative, moderately, balanced, moderately aggressive, and aggressive. Thus, you can choose the profile that best suits your risk appetite. Next, let's look at your monthly investment. This is the amount of money that you can afford to put aside for your investment every month. The more you invest each month, the easier it will be for you to achieve your goal. Apart from those two, you can always edit your desired goal target amount, age, and initial deposit on the top yellow box. Feel free to test out different scenarios on a financial goal simulator and keep editing until you're comfortable with your plan. And remember to click on Save This Goal every time you see a simulation that you like. After that, you can fill in your details and click Confirm if you want to be connected with our experts to better understand your risk profile and receive newsletters on investment tips, products, and more. If you're not interested in that, leave the fields empty and just click Confirm. Before we end this video, remember that financial planning doesn't stop at just planning. It requires your discipline and constant monitoring. For more helpful articles and step-by-step guides to assist you in your journey towards your financial goal, visit our content hub at maybanktoyou.com.my/financialgoals/articles. Here, you can explore other financial goals and learn more about the benefits of goal-based investing as opposed to traditional investment. All of our resources are available to you anytime, anywhere. Remember, a good start is half the battle, so let us help you get started with your financial goal with Maybank Financial Goal Simulator.
So I hope you found that video very useful, and what's more important, how easy it is to just get started. Now remember, if you need any help, all you need to do is make an appointment on EasyQ to talk to our personal financial advisors or any advisors at a Maybank branch near you. If you like, we can also do virtual meetings with you. Remember to stay safe if you have to make an essential trip. So, as promised, at the start of the show, I'm pleased to share with you our special digital wealth promotion from August 26 to October 15. All you need to do is to use the Maybank to You Financial Goal Simulator and save your goals or wealth report on M2U to gain entries to a lucky draw where we will randomly select 10 winners to win a prize worth 500 ringgit. What's more, the first 100 customers who join Maybank Privilege and complete their wealth report on Maybank to You will also receive a special gift worth 50 ringgit. So hurry and log on to Maybank to You to perform your wealth report today. Now with that, I'd like to thank all our audience for watching, and I wish you a very good and happy week ahead. Join us next week as we talk about how to stabilize your wealth and leave a meaningful legacy. Until next time, take care, stay safe, and don't forget to tell your friends and family about this series and the importance of financial planning. See you next week.